Good morning, ladies and gentlemen. Well, we are reaching La La Land, as the title of this video implies. This is a chart of the 10-year note, both yields and futures, and we are exactly at 125.09, which has marked the pivot point between bullish and bearish markets. That is the 234 level of yield. The market has done exactly as we thought. It's come back and tested it, and now we are ready to make the big move. Either we will go and break the 260s, or we'll come back all the way below 2% in yield. Fortunately, we don't have to choose between the two, because we have the options, which are now trading at 2.25 for March. So that is 4.5 months worth of volatility, which they are giving to you for 2 points. Just to show you how stupid that is, well, we were trading a month ago, we were trading over 127, and we could easily go below 123. So the straddle, the 125 straddle in March for 2 points and a little bit of change is a real bargain. We will definitely either go and break this level, or we'll go and break this level. We are now poised for a period of very large volatility in fixed income, which might be the result of commodity moves, and it might be a result of asset reallocation from equities, or the continuation of equities. But in any case, we think that fixed income is now poised to make a big move either way. One of the main reasons we are convinced that the US bond market is getting ready to make a big move is because a big move has to be expected now from the European markets. This is the yield of the Italian bonds, and you can see that it's trading at 180. 180 is now over 60 basis points below US rates. Therefore, if the Italian bond continues on its path down towards 120 or so, it is quite impossible for US rates to remain where they are. We will either get a catch up in US rates to well below 2% as a result of some economic dislocation, or the Italian bond will turn and go much higher, over 3% at some stage, being dragged by the US. So this situation here is absolutely untenable. And if we look at the 10-year yield in Germany, we will see the same thing. This is again the weekly chart. You can see that the Bund is now completely in no man's land, waiting to see what the next move is. The Bollinger Bands are contracting, showing signs of future volatility, so we will either come back into even negative territory for the Bund, or we will very soon start spiking up towards the 1% level. We are basically in an unsustainable part of the trading range, and we are expecting big volatility from both Italy and Germany and the US in the weeks ahead. Something big is brewing, we don't know what, but the yields are telling us that this is an unsustainable position, and that we should get very long of very cheap volatility. As we do not tire of saying, the transmission mechanism between European yields and US yields is the dollar index. And here we have the level that we've had for such a long time, 96.50, another very important swing level. in the dollar index, with the 38.2 retracement of the whole move down around the 95.90. So between 95.90 and 96.50 is our objective on the upside. This would be a very nice retracement pattern, and from there we would be expecting for the market to turn and go a lot lower. For that to happen, we have to have yields falling initially in in Europe, and the widening of the gap between Europe and the States, and then a big narrowing of that gap as we break the previous lows and go down to below 90. But you can see that when he gets here, it's going to be pivotal either way. If we break and stay above this trend line and the 200-day moving average, we will be in a new trading range, which could take us all the way up towards 101. So we'll be in a new trading range, 96 to 101, with whatever those implications are for the yield differences. But in any case, you can see how unsustainable the current position of yields is. Either they're going to go much higher or they're going to go much lower, and the dollar index is another symptom of that, and it's showing you that once it gets to that level, either it's going to fall apart down to 90, or it's going to go much higher towards 101 initially. Therefore, we have the almost certainty that a trade of long volatility in the United States fixed income market, which is 4 months at only 2 points for a straddle, is incredibly cheap. If we extend that view to weekly charts, you can see how the moving averages and the Bollinger Bands are concentrated around the 96.60 level. In a couple of weeks that will be 96.50 or 96.40, but you can see how important that level is going to be, and you can see that it's going to be absolutely pivotal at that level what the market does. In any case, this is the harbinger of very large volatility in US fixed income markets. We don't see any alternative to it. As always, when we talk about any trade or any trend, we need to look at potential triggers. This is a chart of the SPY, so the S&P 500 against a basket of commodities. This is a commodity DBC, which is the main commodity ETF. And to everybody's surprise, since the beginning of the summer, the DBC has been a much better buy than the S&P 500, which has been going up by leaps and bounds. It has finished the week below the 200-day moving average, and the 50-day moving average is coming very fast to cross it. It is still in this in this channel, but it's showing you that commodities are definitely waking up. So what is the potential scenario? The potential scenario is that we have a commodity spike over the next few months, and that drives yields much higher as people start thinking that the Fed is behind the curve. On the other hand, if commodity prices were now to come back very substantially, people will start talking about deflation, and people will start talking about the growth that the world economy has been showing as collapsing. So you can see that we are definitely at an inflection point for yields, and either way you will have much higher or much lower yields in the months ahead. And if we return to our three commodity charts that we first showed you about a year ago, well, we are beginning to motor. We have now the third chart, which is the most sensitive to energy, breaking the level that we said would be the trigger for a substantial move higher. And the other two are getting ready to make similar moves. So we are quite comfortable that all the pieces of the puzzle are falling into place. We are quite comfortable that we are going to have either very big moves up in these indices, or they will fail and they will collapse. But either way, they're telling us that there is going to be price adjustment coming up in the very near future, and that volatility is the way to go. From these charts, we can definitely see that the price sensitive transports are in a much worse shape than the S&P 500 itself. The transports have failed to make any headway and are looking ready to come down and test the bottom of the of this trend line, of this channel, which is where we were months ago, and basically around when the S&P was around the 24-25 level. So you can see what an enormous divergence we have here. And this is actually telling us that people are afraid of a commodity spike, of an energy spike, and that something is preparing, something is afoot, and that we should be very wary of being certainly not short of volatility, but we should be long of volatility in all asset classes, because things are about to change and shift quite dramatically. If we look at the volatility spreads against the S&P 500, we will see that at this level of 135, we have surpassed the lowest level of implied volatility ever on a spread. So if you buy volatility here, you're actually buying the lowest volatility in, well, that anybody can remember. And given the fact that we see these potential shifts in energy prices and commodity prices, and that we can see these large changes in interest rates, we very much doubt that the market will not become very volatile at this point. We still think that the most likely outcome is a very rapid move down towards the 25.05, 25.10 level, on the back of some shock, and some retracement before a very large move back down towards the 2400s or lower. We are quite convinced of that, but that doesn't mean the market has to do that. But what we are saying is that either way, the market will start getting much more volatile in the period ahead, because if you have rapid shifts in interest rates both up and down, you are bound to see repercussions in the equity markets, and therefore we are quite convinced that this cannot stand for very long. One final chart that we think is now becoming quite relevant is XLK over SPY. We can see this is a weekly chart, and we can see the vast outperformance that XLK is enjoying against SPY. This is now probably coming towards an end of a trend and resistance above. So we have a situation in which we will probably have pullbacks, but these pullbacks are definitely buys. XLK is a much more volatile contract than SPY, and therefore during equity swoons, it is subject to greater volatility to the downside. But it is definitely a buy. It is in full trend. Every time it dips, it should very much be bought against SPY. It just shows you that XLK is what we have been arguing for a long time, is America, and is the only long-term hold. The only decision is where from. It actually shows you that we are coming to a period of increased volatility in everything, because if XLK is going to be volatile from here on, that will make absolutely sure that SPY is volatile in return. So whichever way you cut this cake, volatility is about to take a big jump. Here we have a chart, a weekly chart of dollar yen, the provider of liquidity, as it were, to the market. We are at a very important level, 114.50. We have not been able to close above 114.50 all year. So if we were to break 114.50 on a weekly closing basis, we would probably accelerate another leg higher in equities, and possibly a move all the way up to 120 or so by the end of the year. We are less afraid of the leg higher in equities because we think that additional liquidity is going to be very marginal driver of prices. But we are showing you this as a warning to what might happen if we were to fail to break 114.50. You can see that every time the market has retraced all the way back down towards the 108 level. And if we were now to go from this level down to 108, we would probably have a very, very difficult position for equities in the weeks ahead before year end. It would really be a very, very interesting scenario, and one in which volatility would play a large part. And one final hint about what is to come. This is a chart of Berkshire Hathaway against the SPY, a ratio chart. You can see that actually the market is getting more and more stable as time passes and as Berkshire becomes more and more representative of the S&P 500. Well, on Friday, the Berkshire took a large move down. So what we are seeing is a market, a stock which could be leading the market. It closed at the lowest levels of the week, and actually it broke the previous week's low. So it is quite possible that Berkshire is indicating and leading the S&P to the downside by several percentage points, and therefore another confirmation of our thesis. The volatility is about to hit the equity markets via probably the fixed income markets. To sum up how to play this, well, 125 straddles these 2.25 points. You know your downside. It is very unlikely that this will not see a profit in these expire at the end of February, so we have a lot of time in which to make money from them, both on the upside and the downside. Commodities are showing the first signs of a spike, which could really make these motor. Whether we get to 2610 in XPX is a big unknown, but certainly buying very cheap long-term puts is what we are doing and what we are recommending. This will all happen via the dollar transmission mechanism. We are watching the 96.30.50 level like hawks, and there we definitely want to buy volatility because it is either going to collapse down to 90 or it's going to go to 101. So we are talking about 500 points in any case, whatever happens at that 96 to 97 level. 96, anything over 96 straddles in DX is what we will put on. confirmation this trade is working very nicely. XLK you have to be long of. On any dip it's a buy against SPY together with one long EM. We're still looking for these XLF and XLI objectives which could give us these targets. We're so close, but in any case we think that volatility straddles at those levels are more than justified. Thank you very much indeed, and tweet to you on Monday.